welcome once again to this online course on financial institutions and markets. I am Dr. Sonam Bhadoria, Assistant Professor at Swami Rama Himalayan University. In today's session, we will take a close look at a class of financial instruments that are synonymous with safety, trust and sovereign backing, gilt-edged securities. These instruments form the backbone of India's debt market and play a significant role in public finance, institutional investment, and monetary policy transmission. While the term might sound complex, it simply refers to government securities that are considered risk-free and those are traded in financial markets. As the name gilt-edged originates from the United Kingdom, where government bonds were issued with gilded or gold edges as a sign of their safety and security. That's why they are known as gilt-edged sovereign bonds. In India, the term refers to bonds or securities issued by the government or state government. These are debt instruments where the government borrows money from investors and promises to repay the principal along with the fixed rate of interest on the time of maturity. Because these securities are backed by the full faith and credit of the government, they carry virtually no risk of default, which makes them a preferred investment option for risk-averse investors and institutions. So, let's begin by the understanding of the different types of gilt-edged securities available in India. There are so many types of gilt-edged securities, those are available in our country. The most common type is the dated government security or which has a fixed maturity and a fixed or floating any type of rate of interest. These are long-term instruments generally ranging from 5 to 30 years, a long time. Then there are treasury bills which we have already discussed in detail and which serve as the short-term gilt-edged security. As we learned about, the time of the treasury bills is 9 days to 81 days. Apart from these, we also have state development loans or SDLs, which are bonds issued by individual state governments to finance their budgetary needs. All these securities are issued through auctions conducted by the Central Bank of India, which is the Reserve Bank of India, on behalf of the Government of India, or we can say the respective state governments. So, now see how these securities actually work. So, let's see. When the government needs to raise funds for its expenditure, whether it's building infrastructure, funding welfare programs, or simply managing the fiscal deficits within the economy, it issues these securities in the primary market where the investors such as banks, insurance companies, pension funds, mutual funds and even individual investors bid for these securities through competitive or non-competitive auction methods. Then, once the security is issued, these securities can be traded in the secondary market, which provides liquidity and price discovery. The interest on these securities is paid at regular intervals, usually semi-annually, and the principal is repaid only on the maturity. Now, let's see what is the role of these type of securities in the financial system. As we discussed, Gilt-age securities play several critical roles in the financial system. Firstly, they provide the government with a reliable source of borrowing to meet its expenditure requirements. Secondly, they help institutional investors like banks and insurance companies to fulfill their statutory obligations. For instance, banks are required to maintain a certain portion of their net demand and time liabilities in the form of statutory liquidity ratio, which is known as SLR. Investments and government securities qualify for this purpose. Thirdly, we can say these type of securities serve as benchmarks for pricing other debt instruments. Since they are considered risk-free, the yields on government securities become the reference rate for the other bonds and the loans available in the financial system of the country. Then, what is the important function, or we can say what is the function they play in the financial system? So, the another important function of gilt-age securities is their role in the transmission of monetary policy. When the Reserve Bank of India changes the repo rate, the yields on government securities often move in the same direction. If the RBI lowers interest rate, the prices of existing government securities with higher coupon rates go up and the yields falling down. This movement in yields then influences other interest rates in the economy, such as those on loans and deposits, thereby affecting spending and investment decisions of the investors available in the country. In this way, we can say gilt-age securities serve as a channel for implementing monetary policy for serving its purpose of balancing liquidity in the country. Then, from investor point of view, we have to think what is the role of this type of securities. So, these securities offer a combination of safety, assured returns and liquidity. Because they are backed by the government, the risk of default is negligible. The regular interest payments make them suitable for conservative investors, especially retirees and institutions with long-term liabilities. With the introduction of Reserve Bank of India retail direct platform, even individual investors can now buy and hold government securities directly. There is no need to go through mutual funds or any type of brokers to buy government securities now. This democratization of access has opened new opportunities for retail participation in a traditionally institutional space. So, let's see. However, the investing in gilt-edged securities is not without any risk. There are risks always available in the market in any type of investment, any type of securities. The most significant is interest rate risk. Since these are long-term fixed income instruments, their prices are inversely related to the interest rates only. When interest rates rise, the price of existing securities falls, and when the interest rates falling down, the price of these securities rises. This means that if an investor sells a bond before maturity during a period of rising interest rate, they may incur a capital loss. Another risk involved here is reinvestment risk, where the interest payments received may not be reinvested at equally attractive rates. Thirdly, the liquidity risk, while generally low, can occasionally emerge in certain less traded issues or during volatile market periods. So let's see how these type of securities are actually traded in the market. So the primary market for government securities is managed by the Reserve Bank of India, where auctions are conducted weekly. The secondary market is facilitated through the negotiated dealing system, or popularly it is known as NDSOM, which is anonymous of electronic order matching platform. Trades are settled through the Clearing Corporation of India, which we have already discussed in the previous lectures. These institutions ensures efficiency and transparency. Mutual funds, banks and financial institutions are the active participants in both the primary as well as in the secondary markets. Here, the retail investors can participate through Reserve Bank of India Retail Direct or Gilt mutual funds. So, let's see what is the scale, or we can say what is the impact of the securities in the market. So, let's talk about the scale and significance of these securities in the market. Consider that the outstanding stock of government securities in India runs into several lakh crores of rupees. The 10-year government bond is particularly important as it serves as the benchmark for long-term interest rates in the economy. A fall in the yield of the 10-year bond is often interpreted as a sign of economic optimism or strong investor demand for safety, while a rise may indicate inflationary concerns, or we can say the fiscal stress on the economy. So, let's see what are the recent developments that has been introduced in these type of securities. In recent year, the government has introduced several innovations in gilt market. These include the issuance of inflation indexed bonds, then floating rate bonds and the green bonds. Here, the inflation index bonds protect investors from the erosion of purchasing power by linking returns to inflation rates, and the floating rate bonds have variable interest payments linked to a benchmark, reducing the interest rate risk. Third, the green bonds. As the name is showing, the green bonds are used to finance environmentally sustainable projects and appeal to investors with ESG, means the environmental, social and governance criteria. These innovations have broadened the appeal of government securities and attracted new categories of investors. Let's think about a simple example. I want to give you a very easy example. Suppose a bank has a statutory liquidity ratio requirement of 18%. To meet this requirement, it purchases rupees 500 crore worth of government securities with a 10-year maturity and an annual interest rate of 7%. This investment not only meets the regulatory need but also provides the bank with a safe return. If market interest rates decline after the purchase, the value of these securities increases, and the bank may even book capital gains by selling them in the secondary market also. So, this is the way the bank can earn maximum return in the market from the future. Conversely, if rates high, the bank may prefer to hold the securities until maturity to avoid losses. This dynamic plays out across thousands of such transactions in the Indian debt market every day. So in last, we talk about the conclusion of this session. In conclusion, I can say Gilt Age securities are an essential part of India's financial ecosystem or the India's financial infrastructure. They offer a risk-free investment avenue, help the government finance its operations, provide a benchmark for interest rates, and facilitate monetary policy transmission. With growing market depth, digital asset platforms, and product innovation, the gilt market is evolving rapidly to meet the needs of both the institutional as well as the retail investors. As an aspiring finance professional, understanding this segment is not just useful but it is essential because without the government support, without the government securities, the financial system cannot be complete. So, as we conclude this session, I leave you with a few questions for the reflection what we have learned today. Think, how can the government make gilt age securities more attractive, more beneficial to the retail investors? So the good number of retail investors attract to these type of securities. Think, what role do these instruments play in promoting fiscal discipline and the market transparency? And finally, you have to think, how do innovations like green bonds and inflation index securities change the dynamics of public debt? Thank you for being a part of this session on gilt age securities. In the next lecture, we will learn about the equity shares and their meaning and what are the different features of the equity shares are. Until then, keep reading, keep analyzing and stay curious about the ever evolving world of financial markets. Thank you. Namaste.